Today we're delving into more detail on the PSG Flexible Fund, and joining me is Fund Manager Shaun Roux. Now, just by way of introduction, the PSG Flexible Fund is the largest fund in its category. It's got a almost 25-year track record, and since its inception on the 2nd of November 1998, the fund is ranked first in its category as at 30 September 2023. So, the fund has a long and proud track record of delivering alpha to its investors. So, Shaun, to kick off the discussion, I think when many people hear flexible fund, what they expect is a fund that makes lots of changes to the portfolio allocations. And the PSG Flexible Fund does have the ability to allocate to a variety of asset classes. However, looking at the asset allocation of the fund, we see that despite the current turmoil in the markets, there's a relatively low allocation to, for example, bonds and money market components, both locally and globally. So can you give us an idea, when considering the asset allocation of the fund, how you combine the asset classes to reach the fund objectives?
Thank you, Audrey. The primary objective of the PSG Flexible Fund is to achieve equity-like returns at lower levels of risk. This means we're aiming to grow capital, but we have a careful attention to the risk we're taking to get there. In times when our buy lists are full and we're finding lots of opportunities, we're going to be running with low levels of cash, but there are times where we can't find many opportunities and cash levels are high. For example, in 2018, we had 40% of the fund in cash. But as you suggest, right now cash levels are low. So you can conclude that our buy lists are full, both globally and locally, and the opportunity set for long-term returns is excellent.
Now, PSG Asset Management runs a globally integrated process. So what does that mean, and how do you weigh up the trade-off between local and global opportunities?
Great question. Yes, we have been investing globally for 15 years. We run one process. What that means in practice is the same team is picking stocks, both abroad and locally. We have two buy lists, a local buy list and a global buy list. But what the PSG Flexible Fund can do, as can all of our funds, is effectively use the best opportunities on both buy lists. So we can compare a US stock to a JSE stock. Some examples of how that works in practice is that currently we're seeing good opportunity in the energy space, but the PSG Flexible Fund doesn't own Sasol. We would argue quite convincingly that Shell and BP are far better opportunities. Similarly, within technology, there are not many opportunities on the JSE, and our clients did very well out of a stock like Microsoft. And the other benefit of running a globally integrated process is that we're able to construct portfolios that are more diversified and hence more fit for purpose. They can grow the capital over the long period of time, but at the same time they can manage risk more carefully.
So turning our attention to the SA Inc. part of the portfolio for the minute, and we all know there's lots of risks in the local market, are you still finding opportunities? And given the risks that I've referred to, what is the hurdle that you feel that an investment must pass before you allocate towards it to ensure your clients are adequately compensated for the risks they take on?
As you suggest, this is a very challenging time for our country, and the last 12 months, specifically if we reference load shedding, has been very, very difficult. And we would argue our country has been in crisis. But one of the benefits as an investor of times of crisis is that often valuations reflect that. And we believe we're looking at valuations on the JSE that are commensurate with the valuations we saw during the midst of COVID or in the global financial crisis. So we're looking at incredibly cheap assets. And for stock pickers like ourselves, what this means is that if we can select the right securities and securities that can do well even in tough conditions, we can generate good returns for our clients. And if those conditions were to improve, we can generate particularly good returns. And to manage the risk around that, we would be paying careful attention to primarily investing in companies that are showing the propensity to grow profits despite the challenged macro environment in South Africa. And looking further out, the outlook is very, very favorable. So we're looking at a company like Discovery that is far less exposed to the South African economy, has growth levers that are much less about South African GDP. We have healthy investment in infrastructure. We see secular reasons that infrastructure investment will take place and will benefit some of the companies that we're invested in, who incidentally have less competition. And another good example would be the leisure sector, which is still not fully recovered from COVID. So we're arguing there's an opportunity, if you manage risk carefully, to still generate good returns from local investments. But if, and this, I know this is a big if we've seen the worst as far as the South African economy is concerned, South African investors should prepare for very good returns from these valuations.
But Shaun, just thinking for a moment about the environment we find ourselves in, there are lots of concerns in the global market as well. I mean, there's been talk about a US recession for quite some time. And as we know, China's economy has been cooling. So where are you finding global opportunities at the moment?
So clients that have come to understand us will know and appreciate the fact that we often use fear to our investors' advantage. So you mentioned China, and China's been a grave disappointment in 2023. And consequently, a lot of capital has fled from Chinese assets. And companies that are exposed to the Chinese economy have performed poorly, and people have sold those stocks. And as a result, we're able to harness opportunity to buy companies that are deeply out of favor. We do have concerns around governance in China. We battle to get direct Chinese investments over the line in our process. But for example, our clients own a company called Prudential, which is a UK-listed life insurer, which is primarily exposed to Asia and has significant interests in China and Hong Kong, and consequently has seen a lot of selling pressure during the course of the year. And we can buy it very cheaply, and we'd have a high degree of confidence that profits will be significantly higher in the future. So grabbing the opportunities that arise as a result of the fear. But turning to the US, yes, the fears around the impending US recession, which everyone has been waiting for, it's now going on 2 years, has given rise to fear. But we would argue that in most cases, that's not reflected in equity prices in the US. So our global process has been finding far fewer US ideas than in places like the UK or Japan or in a country like South Africa.
So, Shaun, considering the fund objective and what you're trying to achieve for clients over the appropriate investment horizon, and looking at the uncertainty that we're currently seeing in the market, do you believe that there are still opportunities for clients out there, and how do you value the prospects in the fund going forward?
The world is in a challenging position at the moment. Not only have we got very elevated geopolitical issues, and Israel being the most recent concern, but we also have much higher interest rates, global interest rates, than we've become used to over the last few years. And this is going to be a challenging environment for financial assets going forward. This is a world in which it's definitely appropriate to be thinking carefully about risk. At a portfolio level, we think we need to be taking careful measures to ensure that this uncertainty doesn't negatively impact the medium-term returns for our clients. In practice, we have cash, We have portfolio hedges in the PSG Flexible Fund. We have gold stocks, we have energy, and we have a very diversified portfolio that is not all in rands, it's in a variety of currencies, but it's exposed to stocks that are not only cheap, in other words, trade at a wide margin of safety, but we think the profits are less exposed to whether the US goes into recession or whether geopolitical tensions were to rise. But at the same time, this is an environment where stock pickers like ourselves are very excited about the long-term capital growth that can be derived from the investments that our buy lists have in them. And consequently, our funds are still relatively offensively positioned. And also, we are signaling to clients that we think the long-term prospects for returns are good. And we think good things happen from here.
Shaun, that's a lovely, positive note to leave this conversation on. Thank you so much for taking the time to talk to us today.
Thank you, Audrey. I enjoyed that.